Okay. Hi, this is James Eng with Full Capital. Thanks, guys, for jumping on the virtual lunch and learn and trying this thing out with us. It's the first time we've done it, so if there's any technical difficulties, bear with us. But just wanted to bring on the Fluellen Hoover team. We're gonna have Nick speak, Nick Fluellen, Bart Hoover, Sean Scott, and Joey Murray, and we're gonna learn a little bit about the DFW market, and then also about some of the recent closings and listings. And then we're actually going to have a Q&A if you want to put any questions in the chat, and then we're going to try breakout rooms after that. So just a little bit about me. I'm based here in Dallas and have been with Full Capital since 2015. And on the right-hand side, you can see just in like the last 6 months, these are some of the recent deals that I've worked with the Fluellen Hoover team on and finance. So very active in the DFW market, and just wanted to bring them on to let you learn more about them personally, but then also let them give you their insight into the market. And so but before we jump into that, I did want to mention two events that are coming up for O Capital. Number one is our Hoops for Homelessness, which is on March 30th at SMU. As you can see, there's a lot of listing brokers and property management companies who are going to be competing in our 3-on-3 basketball tournament. And so if you guys have any desire to get out there and show us what you got in terms of 3-on-3, love to have you. And then mark your calendars for Wednesday, April 3rd. Mark Dotsauer is going to be speaking in Grapevine. And then you can register for all those events at oldcapitalpodcast.com. And so I wanted to turn it over to Nick and Bard to really get us started and talk about the DFW multifamily market and give a little intro on your team.
Sure. So I'll give a little intro on our team, and then we can dive into just some DFW apartment data, which I know everybody is eager to get to. But as James said, my name is Nick Fluellen. My partner is Bart Hoover, who's probably on your screen here. And we have three segments of our team, which I think makes us a really unique team. And so one of the segments is 76 and larger deals in DFW. And so Bart and I, and then Wes Rock and Trey Caldwell are in that space. And then we have our 75 unit and under team, which is led by Joey Murray, who's on the call with us here, and Matt Aslan. And then we have our secondary markets team. And so we have Sean Scott here with us. We also have Evan Burke and John McGregor on that team. And so we found that it's a really effective way for us to do a lot of deals. We're doing deals really all over this region. For some of you out there who may be thinking DFW is a little overheated, the secondary markets offer a really attractive alternative to that. And so we found that's been really effective. And for some of you who are saying, hey, how do I get into multifamily and how do I buy my first deal? That's the type of buyers generally that Joey and Matt work with. And so, and for those of you out there who we've done deals with or who have done deals with other people and are looking for their next big deal in DFW, obviously we can cover you there too. So that's just a little bit about us. I've been with Marcus and Millichap since 2004. We're just very, very honored to be here today and very optimistic about the DFW market and the surrounding regions. So look forward to diving into that a little further.
Bard, did you want to kick us off a little bit about the DFW market?
Sure. So if you want to pull up some of the stats that we discussed, we have a slideshow that we hand selected a few of the slides that we thought were relevant to the market today. You know, the thing about DFW in general is that we just got back from the NMHC conference in San Diego, and we meet with groups that own property all over the country. And the way Marcus and Millichap does it is that we'll have brokers from different regions around the country, and we'll have, 12, 13, 14, 15 brokers from different areas around the country that'll sit in with a national owner. And basically the national owners will go around and say, hey, we're not interested in Cleveland. Yes, Philly's an area we might look at. They go around all the different brokers. I think the takeaway from the NMHC conference is that everybody likes Dallas-Fort Worth. Dallas-Fort Worth is a very robust business environment, as everybody knows. I mean, we're bringing in over 100,000 people annually, population growth-wise, and then we're bringing in, just under 100,000 new jobs every single year. So, I mean, everybody reads in the papers from both coasts, East and West Coast, these companies are moving into Dallas, flocking to Dallas because it's such a pro-business type environment. And that bodes well for multifamily because obviously that's where our tenant base comes from. So on this first chart right here, this is quarterly job growth. So this takes it back all the way to year 2000. And so you can see where we are job growth wise. I mean, 2017, it was 84,000 jobs created and new jobs created in Dallas-Fort Worth. 2018, it was 117,900, and the 2019 forecast is 105,000. So jobs, population, that's what drives the multifamily market, and DFW bodes well in that respect. Okay, so this slide right here, if you look on the left chart, that's the Dallas-Fort Worth homeownership rate. And so you can see, it took a dip down, at its lowest point in 2015. I think what we found in this last cycle is that the appeal of home ownership is not like it used to be. It has been over the last 30 years. I think a lot of people got underwater in their homes or knew people that did. And so most of the people that are renters today are renters by choice. And so meaning that, especially those that lease in Class A and B properties, they could go out and buy their own home, but they choose to lease. They like to be mobile. They don't like the commitment, the headaches that go with the house. Whereas with an apartment complex, they take care of all the maintenance and everything. So we're right back at about 62%. But remember, one thing about this chart is that we've grown by over 100,000 people a year over this, 12-year chart. So keep that in mind. Now, on the right chart, this is the affordability gap. And so this is the gap between what a home payment would be, a mortgage payment would be, and where apartment rents are. And so you can see the different in 06, it was about $673 difference, and it dipped all the way down in 08, 09 to about $345. Well, now it's up to $984. So what does that mean? That means that more people are electing, like I mentioned before, to rent. Affordability in homes has just gone up every year, as you know. I mean, the hard costs, the soft costs, the labor, into going into a single family home is that just a lot of people, whether they elect to or not, they can't afford to. And so again, that bodes well for apartment ownership. Okay. So this is an interesting slide. So you can see, if you see at the top, Class A, Class B, Class C, and you can see what the vacancy rate has been. It traditionally had been where Class C had the highest vacancy. And now it's flip-flopped. And where we are today, Class C actually has the lowest vacancy rate or the highest occupancy rate at 4.5% vacancy. Class B is about 5.2%, and Class A is 6.1%. So, in our world, we really focus on Class B and Class C multifamily. And so we love to see a chart like this where it's inverted for the first time over the last, 16 years. And so I think some of that has to do with the Class A. You're going to hear a lot about, and you'll read a lot about new construction in Dallas-Fort Worth, and that's a threat, to the apartment market because we're bringing so many units online. Well, number one, I have a couple of comments on that. Number one, still the population growth supersedes that, and so there's still very high absorption rates, and so But Class A will be affected by that somewhat. So as these new units come online, generally they give concessions to get leased up because these are merchant builders that are looking to sell their assets. And so they need to get the occupancy up, and they have short-term loans. And so they need to sell the assets and move on. So they give concessions, and that trickles down to the Class A. But there's still such a delta in rents between Class A and Class B and Class C, of course, to where it really does not have an effect. It doesn't have an effect on us at all. So we were kind of excited to see, you know, for the first time in 16 years, you know, Class B and Class C are kind of the, you know, the lowest vacancy rates. Okay, so this is just a handout. I'm just going to read some nuggets from this. This is our investment forecast, and this is for 2019. And so I'm going to just grab some different nuggets, but you know, number one, the number of households in the Metroplex is set to rise by approximately 60,000. So that's households, not individuals. And so you can see, you know, that's 60,000 families that are moving here. And while some softening is anticipated as vacancy ticks up, positive net absorption remains at near historical highs, encouraging a steady pace of effective rent growth. And so, you know, where we are in the market, you know, people feel like it's softening. It's softening in other parts of the country, but frankly, again, because of population growth and job growth in DFW, you know, the net absorbing of all these new units still remains extremely strong. So it's a cap rate spread narrows between Class B and Class C properties, reflecting shift of investor goals. So, you know, robust supply additions in some pockets of the Metroplex have had little effect on Class B and Class C apartment operations, as new supply is almost all Class A luxury rentals, what we just talked about a moment ago. It really is not having an effect, all these new units coming online in our world, honestly. So vacancies for Class B and Class C properties average well below 5%. Rent growth has been very strong among these asset classes. Class C properties are in high demand, especially among investors seeking value add properties. So, you know, the bottom line is everybody loves value add, and you know, people market that every deal is a value add, other than brand new construction. But the true value add is in Class B and Class C, where you can go in and put some capital into these assets. Even if half the units have been renovated, or we have a deal on the market right now that 95% of their units have been renovated, but to a moderate level. And so there's that next level you can take it up to and get that extra delta in rents. And so you just have to be creative and figure out where is the value to be added on these assets. And we'll go through that property in a little bit, and we'll give you kind of our pitch on that. It's on the market right now, but it's a great example of a property that, again, has been 95% renovated on the interiors, but to a moderate level. And so where are the other sources to drive income on that asset? So we'll talk about that.
Yeah. Hey, Bard, let me add something to what you said. James, if you'll scroll down a little on that page. So just one other thought on the rent. You see the rent is projected, rents are projected to go up 2.8%. But as Bard said, with all the new construction, a lot of those deals have concessions. If you just stripped out the Class A deals and isolated rent growth and the projections for B and C assets, the projected rent growth is almost 4% this year, just a touch under 4%. So there's still a tremendous opportunity in the B and C world, even though there's a perception that the new construction is hurting us. The pricing delta is significant, and so there's still good opportunity in the B and C world in DFW to continue to push rents at a greater rate than what you see there, which is combining all product types.
And I'll add that that's organic rent growth. And so obviously, if you go into an asset and you put $5,000, $6,000, $7,000 a door onto the interiors, it's going to be substantially higher than that 4%. And so that's just organic, what they're predicting for organic rent growth. And by the way, 2018 was right around that number as well.
Bart,
Okay.
did you guys want to touch on maybe some of your recent closings and then maybe some listings that you guys have coming up next?
Sure. So, you know, when we talked about this yesterday, we were talking about, you know, what deal to highlight. We thought Oats Creek was pretty relevant. We just closed it in December. It's 280 units built in 1984. We had a lot of activity on this asset. This is the type of asset that everybody's looking for. There's the current owners had updated about 50% of the units to a moderate level. And so that was the pitch, was to take it to the next level, in addition to other sources of income like water conservation and leasing washers and dryers, adding backyards onto the first floor units where there was availability to do so. So we had a lot of activity. We had 200 confidentiality agreements filled out on this deal. We had 30 property tours, 18 offers. We ended up selling the asset for $86,000 a unit, which was a tax-adjusted 5.11 cap rate. Old Capital did the loan for the buyer. It was a very smooth transaction. We actually did have a little bit of a hiccup because, ironically, you can see 635 is right there. So there's a portion, 635 TxDOT is expanding 635. And so there was actually a piece of the property in the back. We were fortunate because it was only a little piece of land that really wasn't used on the property, but we had to jump through some hoops to get everything approved as it related to that, because they were going to file eminent domain if you know, the current owner didn't come to an agreement on the pricing for what they would sell that piece of dirt to TxDOT for. So yeah, it was a little something, but in our world, we always have some kind of issues on these assets, you know, little ones here or there. So we just worked through it, and Old Capital was great to help to get, you know, the lender Doherty comfortable with that. And so we pushed through and we got the deal closed.
The other property that's, I guess, similar that you guys wanted to talk about was currently on the market here.
Yes. So this property is called Creek on Callaway. It is currently on the market. There's a call for offers date for March 7th on this asset. It's built 1979/1980. It's 247 units. Average square footage 826 square feet. I'm gonna look at my new cheat sheet here. So this is the asset I was talking about earlier, to where 95% of the units have been updated to a moderate level. So the plan on this deal would be to go in and continue to push to the next level. We'll call it a platinum level. So you could go in and you could do 2-centimeter granite countertops. You see the backsplashes right there in the kitchen, tile backsplashes, but that's only in that one unit. That's a model unit. So you would do that in you know, a large portion of the units. Cabinet fronts, the boxes are still in very good condition. So if you did California style cabinet fronts, you know, it would appear when you walk in there that the entire kitchen is brand new, basically. New appliances, granite, new faucet, backsplashes, and cabinets. And so we feel like, and the manager, on-site manager, feels like there should be probably a $75, maybe $100 bump in rents that could be generated from implementing such a plan. Other sources of revenue, actually, so we broke it down on a flyer that we hand out with people when they tour, is you know, you could add one thing that people are doing. So this property has almost all the units have connections. And so what a lot of people do, take advantage of that revenue, and they go ahead and buy the washers and dryers, and then they lease them back to the tenants. Currently, they own some, I think like 23 sets, and then they're leasing some. They're leasing them for $29, and then from the leasing center, and then leasing them to the tenants for $40. They're making an $11, maybe a $12 premium on that. So I would say go in, buy more washers and dryers, lease them out. Your return on investment is very good. Other ways to generate revenue on this, we located 62 locations at a minimum that you could add backyards to, they're on the first floor and there's room to add a backyard. And that's a very important upgrade that a lot of people are taking advantage of today. Is they have their little yard right there and they can let their dog out to go to the bathroom when it's raining, or they can let a young child out and they can hang out back there outside, and they're still safe. And so, 62, and, usually we're seeing about a $75 premium to do so. So that would generate $4,650 a month in additional revenue, which is $55,800 a year. And then reserve parking. They just started implementing a reserve parking plan. They have 17 spaces right now that they're getting a $25 premium. So we pro forma just to add 60 more. So that would be 77 spaces out of 247 that you could literally, you get spray paint and you just say reserved on it, and people will pay $25 to know that their car is right in front of their unit. Because that a lot of times that's the most valuable asset that these renters own. So it's very important to them that they take care of their vehicle. So that would generate $1,500 a month or $18,000 a year. So the way we in our pro forma, not even talking about the rent growth on the interiors, the organic growth we talked about at 4%, plus the taking it to the platinum level and getting that $75, maybe $100 premium there. But just with the yards, the reserve parking, and the renting the washers and dryers, I mean, annually we came up with, if you cap that number at like 5.5%, that's about $2.85 million in value you've created. So that's some of the ways that you can create value in addition to the interior upgrades, is to do what I just spoke about. And I mean, it's incredible, because remember, when you go in and you do this work, all of that goes below the line. That's a capital improvement. So it doesn't affect your NOI, but obviously the income generated does. And so you can create value even on an asset like this that's 95% occupied or 95% renovated to a moderate level. You can create value very easily, very quickly. And so, we think this is going to be a well-received asset. We think we're going to have a good amount of offers.
Well, a couple of other little comments I would add is, number one, there was an existing loan on this deal that's got a below market interest rate. So the cash on cash return is, as is, without doing anything, is already, we feel like, very competitive in the market. But as Bard highlighted, there's a number of these areas that maybe don't meet the eye initially that are great ways to add value. One other comment is, as you're putting together your business plan for any property, obviously you want to study the competition around you to see how viable that plan is. And there is a property adjacent to this one that is about maybe 20 years newer. However, their finish out is not significantly nicer to ours, and they are getting anywhere from $300 to $400 more per month than what we're getting right now. So it's always going to be a nicer deal next door, but if you could be in this deal at a lower basis and have a very competitive amenity package and a very competitive interior finish out and be $200 less than the competition is, we feel like there's a lot of renters in this submarket that would flock to this property. I think it's a great lesson that we always keep in mind as well, that what may not seem like it has a lot of upside, still has upside, and it's our job as brokers to find that upside. And obviously, as you're looking at opportunities and you say, hey, I don't know that there's much potential here, I would challenge most people to keep digging and to keep looking for that little edge that you can find, because most properties have some way that you can really boost the NOI without doing a dramatic overhaul of the property. So we're very excited about this deal. Anybody who wants to check it out, obviously follow up with us afterwards.
Nick, is there a whisper price and call for offers date yet set on
Yeah,
this one?
whisper price is 25.5. And Bard, what the offer date is March 7th.
Yes.
So
March
yeah,
7th. Okay.
so that's the deal. Creek on Callaway in Richland Hills, which is the northeast part of Fort Worth, if you're not familiar with the name of that submarket in particular.
So we'll
So with
jump
all
over.
that, yeah, let's turn it over to our 75 unit under guy on the call here, Joey Murray, and he can shed some light on a couple of a deal that they did last year and some of the stuff we've got going on right now.
Yeah. The deal that we did last year was Hilltop. It was in Farmersville, Texas, which is in Collin County, just a little bit north of DFW. It was a 1984 product with 24 units. So kind of as we touched base a little earlier in the call, we help new investors get into a multifamily deal. Size for us is not a factor. So anything 75 units and under, we come in and champion for our sellers and help buyers get into the deal. So we had a lot of activity on this deal. Most people aren't all that aware of where Farmersville is, but we still ended up getting somewhere around 143 CAs on this deal. We had 15 tours, ended up getting 10 offers on the deal, and we invited 5 back to best and final. Ended up awarding the deal to a buyer who inevitably was not in the top ranks going into call for offers. So that kind of goes back to, we help you navigate the deal, and he ended up jumping in and winning the deal at the end with substantial amount of hard money and coming in with some other aggressive terms working with Old Capital. So the kind of the pitch on the deal was that it was really close to Lake Lavon, right on the 380 corridor, which is seeing a lot of growth. This owner put in a lot of interior upgrades, but kind of left a little bit on the back end for the next buyer. He ended up putting in a lot of new floors and paint on the walls and fixtures, but a new buyer could come in and add value by putting in Formica countertops and new appliances. A little bit unique thing about the deal also was that it had 16 self-storage units on the same site. I think that scared off some people, but also presented a huge opportunity. This owner really focused on the interiors and left that for the new buyer as well. He only had, I think, 1 or 2 of those occupied. So a new buyer could come in and just lease that out on the rest of the 14 units. And there was enough land there to where you could actually either come in and build an additional 16 self-storage units at least, or do boat parking on the opposite side. The other upside on the deal was there was a unit that was converted to a laundry room, had the electricity and the water run, but it wasn't finished out. So new buyer could come in and just finish what the current seller had already started and really add value to that property and continue to push rents. That was a really great and unique deal that we ended up getting traded.
And then Joey, what's the new deal that you have currently on the market that you wanted to talk about?
Yeah. So Glendale Oaks, we have a 3 properties in East Dallas currently. I'm only going to focus on Glendale Oaks today. It's 40 units, but there are 2 other properties that I can speak in detail off call if someone would like to kind of come to these deals. Again, 75 units and under, more than likely, most of the people are probably more interested in getting into a 140 unit deal, but we can absolutely talk about the rest. So this deal is right on Live Oak. It's a corner lot. It's about 1.3 acres, and it's 40 units in a 1968 vintage. The real upside here, the seller has put a good amount of capital expenditures into the property, but he's left a lot of value add for this neighborhood on the back end. These deals are really appealing to a young professional demographic. And so you could come in and put granite countertops, backsplashes, gooseneck faucets, and even change the fronts on the cabinets and be able to add about $125 at minimum on your rent bump. Not to mention that you're in an infill area of Dallas, right on one of the main drags going into downtown and through East Dallas. It's a great location. Unique thing is that it's got quite a bit of parking. Most of the deals in this area, parking is a big issue. And so it's one of the largest lots. We think that it's a great asset that someone could come in and add some value.
All right. And then Sean, do we want to jump over to Sean now and tell us a little about what secondary market deals you guys have on the market and what you've closed recently?
Sure thing. Thanks, James. So maybe kick it off here with one that we recently closed. There we go, Aspen Walk. I guess first just a tiny bit of background on secondary markets team. Obviously working outside of DFW, that actually also includes neighboring states. So Oklahoma, Louisiana, New Mexico, all places where we've closed deals. And so this was one we worked on recently that's in Oklahoma City, actually. Closed just before the end of the year. And really great property, very clean, blue collar area, but very well run. So about 150 units, about 2/3 of those, maybe just shy of that, had been updated. And so, really a good looking property. And I think the seller made a very clear roadmap for the new buyer on where to go with the property in terms of continuing to upgrade units and get those rent bumps that go with it. One of the things that I thought was a little bit interesting about this property, and going back to something Nick mentioned earlier, is this property actually ended up being an assumption of the existing loan. We haven't seen a ton of those in recent history, especially with how low rates have been over the past several years. There's been a lot of opportunity for putting new debt on properties and really seeing an advantage there. I think with where rates are today, we're probably still going to typically see that. But this was one of those situations where it actually had a very attractive loan on it. And so the buyer assumed the loan and will be putting on a supplemental in the near future to get some of that money back out. So really pretty interesting deal. And like I say, interesting both because outside of Texas and because of the assumption.
Yeah, on these assumptions, you're typically able to buy the deal. Since the seller doesn't have a big prepay on it, they're able to buy the deal at a better basis. And then as long as you can raise the equity to close that gap, then you're in good shape. So let me flip over to the next deal that you guys currently have on the market. Is this Woodland Trails? Okay.
Right. So this is a property in East Texas. Built in 1985. It's 72 units. This is a property that is a great property in a great location. Definitely could use a little bit of TLC. The Nacogdoches market really has not had quite as much attention from builders in recent history as some of the other markets in Texas. So we haven't seen quite the same increase in supply there. So I think, that alone offers some good opportunity for a new owner because there's really just less to compete with, whether it's A, B, or C class. And so this property, we've got a whisper price out there. We think it'll be in kind of the low to mid 3 million range. And what we really see is a new owner coming in, doing some CapEx on the property, a little bit of cleanup on the exteriors, as well as some interior upgrades to really get it on par with some of its top competitors in the area. And from there, I think we're going to see some really nice returns for a new owner on this one. And then I think we have one more in there too, or?
What was the name of the other one?
Homestead.
Homestead. Yep. Let me pull that one up.
Yeah. So this one is really representative, actually, of 4 that we've got on the market right now. And I think these are interesting deals. 3 of those are actually in New Mexico, and 1 is in Texas. And so this is one of the ones there in New Mexico. All 4 properties are actually A-class properties. They are in markets that are just absolutely on fire. They are so hot, it's hard to believe. You're seeing typical occupancies in the high 90% range. We've seen huge rent growth and expect to see more of that as these markets continue to grow pretty quickly. Hobbs, for those that don't know, is just 1 mile over the Texas-New Mexico border on the New Mexico side. Yeah, there you go. So it's got a nice advantage to it in that property taxes are lower in New Mexico. And so you see some nice savings there. But these A-class properties, they're really in secondary or even tertiary markets. Because of that location, you can come in at a much higher cap rate. So while you might be looking at a C deal in DFW at a 6.5 cap, in Hobbs, you can look at an A deal at a 6.5 cap. And so you can step into a property like this one, 240 units, completed in 2016. And like I say, at a 6.5 cap, really, really good income on the property. This is going to have great yields to it. And because that market is growing so quickly, we are projecting continued rent growth, and occupancy is not going to be able to get a lot higher, but it should stay right up at the level where it is.
All right.
I think one of the interesting things too, just about that macroeconomic area, it really is in the Permian Basin. And so a lot of people know that as oil country. A lot of people say, I'm not really interested because I've seen the ups and downs of oil. I'm sure the apartment market goes with it. I think historically that's been true. What we've seen in the past 2 to 3 years is that the economics have changed significantly. So the number of pump jacks is actually reduced, even as the amount of oil being exported is increased. And that's because the technology has gotten much, much better in the last few years. So now the typical break-even point is right around $30 a barrel. So even at $35, $40 a barrel for oil, these oil companies are making very nice profits, as we've seen recently with oil in high 50s, low 60s. The profits are extraordinary for these oil companies, and they are in growth mode just as much as they can possibly be. So that's part of the reason we're going to continue to see growth in those markets. But then for those worried about the downside, again, before those oil companies really want to shrink, we've got to be moving down really below $30 a barrel on oil. And, that's not a mark that I think anybody can see coming anytime soon.
Great. Thanks a lot, Sean. So I wanted to go into a little bit of Q&A here for the whole group. So if anybody has any specific questions for these guys about these deals, go ahead and type it in the chat, and then we'll go ahead and ask those. I had a couple questions ahead of time, so let me pull those up. So maybe Bart or Nick, if you guys want to take a couple of these questions that we had come in. Let me see if I can unmute Nick.
There we go.
There we go. Okay. So, at this point in the cycle, how are buyers sort of mitigating their risk?
Oh, well, I think it's a good question. First of all, I would just say when it comes to real estate investing as a whole, one thing that you can always know is the value is always going to go up. It may go down in between it going up, but if you have one of the things I think is that people are doing is making sure they have the right equity, at least more seasoned people, the right equity that can withstand potentially a recession, that is not just ultra dependent on making sure they get their quarterly distribution or whatever that may be. You've got to be at this point in the cycle knowing that history is going to repeat itself. Eventually, we're going to have a slight dip and downturn. Now, with all the information that Bard provided at the beginning of this, with jobs and population growth and the business climate here in DFW, we're in really good shape. But I do think making sure you have the right equity, making sure you have the right debt, making sure that I would think putting a variable loan on a deal right now would be pretty risky. You don't want that loan to be called due right in the middle of a downturn. So, I think, and I also think, one thing that we're very big on is the 12-year Fannie loan. I just think it gives the interest rate's very comparable to a 10-year, but it gives you more interest only. It gives you 5 years that you can operate a deal and still sell and let a buyer get a full supplemental. And it takes the risk out of it. If you do a 10-year loan and you decide, I plan on selling in the first 3 years, and then ultimately the market's not in good shape to sell at the end of 3 years, well, then you've still got protection, but you've probably hurt yourself in terms of the value as you exit the deal, because you're going to have a big prepayment penalty, and a new buyer's not going to be able to get a good supplemental. So I think in terms of DFW, those are a couple of things I would say. I think in the other markets, I think people are hedging just by being in the other markets. I think that's a real way to geographically diversify yourself, and not have all your eggs in one basket in one market. We're also seeing more and more investors not just geographically diversifying themselves throughout Texas in this region, but there's a number of investors that are flocking to Florida and exploring some of those markets out there. We've had investors that have gone out to Arizona. As Sean said, we've sold deals in New Mexico, and Louisiana and Oklahoma. We closed a deal in Kansas City last year. So there are a lot of ways to hedge. And then the last one I would point out, and I don't know if any of the other guys want to jump in, but for those of you who are investing passively in deals, I've found a number of funds that are pretty interesting to invest in passively, where you may own a smaller piece of 10 deals, but they're all over the place, and maybe they're different vintages, et cetera. So gives you some opportunity to be not only geographically diversified, but also diversified over A, B, and C type properties. And I think there's more and more investors, some of the larger investors that probably everybody on here knows or has heard about, that are starting to think about potentially doing a fund to raise their equity moving forward.
And I'll add that, for me personally, at the end of 2018, my wife and I always meet with our financial advisor, and we go over our stocks and mutual funds and everything to see when, the kids' college funds and retirement, to see where we are. We lost 10.5% last year. And he was patting himself on the back because the S&P lost more than that. And, so I think my takeaway, I always think about diversifying, but I'm not sending him any more money. I'm trying to find multifamily deals to invest in. And so, because I'm sitting on some right now, and I'm like, I'm not doing that again. So we still feel very strongly about multifamily investing, even over other product types in commercial real estate. Just there's more flexibility. You don't have all your eggs in one basket like you can in some of the other product types like industrials or triple net deals. So we're still very bullish. And again, it all comes down to the economic drivers. Okay, job growth and population growth. And I'm going to say that over and over again, because there are other parts of the country that do not have that. And they feel it. Like in the last recession, they felt it. It's much more of an upward and downward swing. Dallas-Fort Worth is pretty steady Eddie. And you saw some of those graphs where we were losing jobs and everything, but I'm telling you, occupancy rates dipped to very little. And so, as long as you're in a good location, and you have on a limited basis, if you have a good sponsor and you have good debt, you're going to be fine. So that's our feeling on multifamily and DFW and the state of Texas, really.
Bart, are there any submarkets that you like more, or that you think will outperform in the next 3 to 5 years, maybe in DFW?
Well, it's interesting because a lot of the job growth is moving out north. And so you're looking at Plano and Frisco and Richardson. So a lot of these companies that are relocating here are relocating out there. And obviously that's some of the best areas in DFW. And so pricing has gotten kind of crazy there. So there's really not areas. We're more deal driven. And so, I mean, I think there are some pockets that are just south of downtown Dallas that are a little bit rougher. There were a couple of areas in Fort Worth that, historically had been considered a little bit riskier because the tenant profile is a little bit rougher. They're going to be rougher on the property. You're going to have more delinquency and bad debt, et cetera. But there are really not any areas that are all of a sudden high growth. We do see some people moving into southwest Fort Worth. Arlington and Irving, Grand Prairie have always been very desired markets. Hurst, Euless, Bedford, Richland Hills, North Richland Hills, always desired markets. Moving out east into Garland, Mesquite, those are good markets. As you go down south, in the last year and a half or 2 years, as you go farther south of downtown, down around Duncanville and DeSoto on I-20 South, that's become a very popular area. So there's very few areas that I would say not to invest in, but everywhere else, I think it's deal driven. And so I would say that focus on the deal more so than a particular market. Now, if you can pick up a deal in Plano or Frisco or Richardson, then obviously that's a great opportunity, but you're going to pay more. The yields are skinnier. So
Well, and I would just add to that there are a number of very sophisticated investors who have started looking even in some of the rougher areas because that's where you can find the cheapest deals. And they feel like with the fundamentals, the macro fundamentals of the DFW metro area, that there's no way that those aren't going to be winners. Now they're going to be very management intensive and you're going to probably deal with some difficult tenants in the early years, but as they just feel like those are areas that have no choice but to get better, and the rents are going to keep rising there. So, I'm not necessarily suggesting everybody go out there, but I totally agree that there's opportunity in every submarket in DFW. And it used to be we had a big X on some submarkets. And ironically, some of those submarkets are the ones where we've seen people come in and make a killing. So I think every opportunity is unique. And just like we said before, even when maybe others don't see value, there's value there. And so find it, extract it, and you'll do really well.
So when you guys call on a lot of sellers, what is their feel sort of, is this the right time to sell? Why are they selling or not selling deals right now?
Yeah. I think the most common thing we hear is, I'd love to sell, but then I'd have to buy in this market right now, which on the surface is that makes sense. Of course, the immediate question I would have is, well, you could wait till the value of your property drops and then you could buy in a lesser market. I mean, that doesn't really make sense either, right? So what we have found almost always is that most of these sellers right now have a ton of equity. And so they may have a very low basis in their deal and be able to sell it for a number that they would be high-fiving everybody at. But then again, there's that concern about, hey, what do I buy? Well, the reality is most of the time their return on equity is not very good. And so if we could take all of that equity in that deal, reposition it into a larger asset, even if they buy it at an aggressive cap rate, almost always we can find a deal where somebody would double their cash flow. Almost always. So, that's the conversation we have, and that's an analysis we do. And sometimes, the suggestion or the recommendation from us is, hey, why don't you keep this a little longer and do this, and this, and we think you could really get a big pop there. Sometimes it's, hey, we've got 5 deals listed right now that all would put you in a much better position than what you're at today. We had a meeting with a gentleman yesterday who has a ton of equity in his deals, and to us, that one was as clear as any meeting we've ever had, that you need to sell these deals and move into better quality assets that you will more than double. In one of the deals, we thought he could potentially quadruple his cash flow. He was really struggling with the management on this deal, but had a ton of equity in it. And so it just didn't really make sense to stay the course and grind for a nominal increase in value when you could turn around and make 4 times the cash flow, 4 months from now. So that's probably our most common answer to that question.
Is there anything that is, so once you get the seller to agree to sell the deal and you list the deal, and now you've got, let's say, 5 to 10 offers on a deal, what is differentiating that sort of last GP or general partner to win the deal?
Well,
anything that sort of is different this year versus last year?
no, it's hard to say this year. It's still early in the year, but I will say, I mean, just historically, obviously, we like for people to be very buttoned up, and we like to see that they've put a lot of time and research into this. So they know, so we know exactly where their equity is coming from. We know what kind of debt they're going to be putting on the asset. We know what kind of capital improvement program they're going to be implementing on the property. And so it's non-refundable money is, over the last 3 or 4 years has been a requisite that was absolutely mandated, or you're not going to win a deal basically if you did not go hard with a significant amount of money. And so being comfortable with that amount of money going non-refundable day one, there's very, very few deals anymore to where a buyer is selected that they have a true due diligence period, 15, 21, 30 days to where they can go in, because sellers are like, they want to know that they have a deal. And so hard money obviously speaks very well, but we like to know, we like to see when people have said, here's where I've adjusted for taxes, and they've dug into the asset. They've gotten their management company to underwrite on the expense side. They know exactly where they think their expenses are going to come in. And so that's what, and you can tell the people that have spent more time on it. There are those people that are kind of flying around throwing offers on various deals, and they really haven't put a lot of time and effort into it. And if they're ever awarded a deal, it's kind of like, now I got to do my research, and so those are the kind of people we're trying to avoid. And I think the seller can see that. We just present the evidence to the seller as exactly our conversations we've had with this particular buyer. And, we feel like they're the best fit for this asset.
Yeah, there's been a couple questions that have come in that I thought maybe we could touch on real quick. One was talking about on an assumable loan, if it requires more than a 25% down payment, what's the best way to get a bridge loan for the difference of amount? Well, I would say there's a couple of things that I see people do. Number one, you can get a mezz loan, which is probably not a real viable strategy for most of the people on this call. It's expensive money. The mezz lenders would probably want that to be a certain minimum amount, which is probably too great for the type of deals that we're talking about here. But one of the things that I've seen, just as an idea for you, is as I see a number of people raising, private equity, just having a different class of investors. There are so many people that are looking to put money out there that would be very happy making 7 or 8% on their money a year, And so if you wanted to have a priority tranche of investor, and you can call it whatever you want to call it, investor A, and all they do is they get 7% on their money and they don't participate in the upside, that's a possibility to bridge that gap. And I've seen multiple equity raises here recently where those positions filled up immediately, just with people that are closer to retirement, that are just looking for some place to put their money, that don't want to be in the situation Bart described earlier, where they've got a bunch of money in the stock market that loses 10%. If they could just make 7% and feel pretty confident in that, there's a lot of people that would do that. So I think that's, in my opinion, that's probably the best strategy to raise some additional money if you end up needing to put, say, more than 25% down. Now, what that amount is it 6%? Is it 8%? Is it 7%? I don't know. I would always tell people to test it out and see. But my guess is if it was 7% or 8%, you would have no problem raising a little pool of money that didn't participate in the upside, but just knew that they were going to be first priority after the lender gets paid, and that they would get that money when the deal sold first. The second question was in regard to my comment about the 12-year Fannie loan. And the question is, what else do you consider good debt? Obviously, there's some repositioning going on, and people are putting bridge loans on deals right now. Is that a poor strategy? Well, I would say I would just say proceed with caution. I think obviously sometimes a bridge loan is the only type of loan you can get on a deal. I think if you're going to be doing a deal like that, you probably ought to stress every model you have and make sure that, hey, if this deal doesn't perform like I think it's going to perform, then what? If interest rates go up 100 basis points, which I don't think is going to happen, but if they did, then what? Am I going to be in a pickle? If I needed to get more money because the only permanent loan I could get on the deal did take out my bridge loan, could I do that? But I would say lenders do not want to own property. So most lenders would work with you if you're staying the course and doing the right thing. But you just don't want to be in a real tough spot where it's time to take out the bridge loan and we just happen to be right in the middle of a recession. So any loan that was due, say, 2 years out from today, I would be a little bit nervous about, or I just want to make sure I had a plan if the market were not exactly in the same state as it's in today. Now, that being said, most of the bridge loan deals that I'm seeing are pretty much I would slam dunks where, okay, well, even if I don't hit a home run on this deal, it's still going to be a double and I shouldn't have any issue. But if your deal is iffy or borderline, or you're trying to make something happen and it's not what you would consider a home run today, then yeah, I would just say proceed with caution.
So
Yeah,
go ahead, Bart.
Ironically, yeah, let me add to that. Ironically, over this last cycle, those that did put bridge loans on deals look like geniuses, because people that did put a 10 or 12-year loan, if they ended up selling in 2 years, 2 or 3 years or something like that, a short hold period, then they had a huge yield maintenance that they had to pay off for the next guy to be able to come in and originate new debt. So, it's a tough one. I mean, certain deals, like Nick said, they don't qualify for long-term debt. And in that case, then absolutely you have to do a bridge loan. And, they're interest only, full term, 2 or 3 years. And then you can either refinance or sell the asset, after you implement your capital plan on the property. So I like bridge loans in a lot of circumstances personally. But you do have to be careful, and you want to hit the ground running to make sure that you have your capital plan that you can put into place quickly, because you want to implement that plan, and then you want to go ahead and move on from that and sell it to somebody who's going to put permanent debt or refinance it at that time.
So someone sent me a private question, and I thought it was a great question, so I'll just go ahead and pose it for you guys. We talked about vacancies on A, B, and C properties earlier, and in 2008, the Class C vacancy was so much higher than A. And I guess the question now is, they've inverted, and so Class C is only 4 or 5%, but A's are 6%. And the question is, if there's another downturn like 2008, what's going to happen to Class C vacancies?
Yeah, I mean, I would say that the B space is probably the safest space to be in, but I would also say the C space is the second safest place to be in, and the A space maybe would make me the most nervous. The difference obviously right now is construction costs are just extremely, extremely high. And so all of these Class A deals have to lease at a very, very high rental rate in order for the deals to be viable. And the land is expensive and the construction is expensive and it takes time, and it's just not easy to build right now. Despite all the units, the 28,000 units that are being built here, it's costly. So that delta is greater than ever before. And so if we got into an environment where people had to pull back the reins and go find somewhere cheaper to live, obviously the Class A deals would have to do more concessions and drop rental rates and that sort of thing. But that's going to be really hard for most of them to do, because their deal would not work if they do that, at a significant level. Whereas a lot of these Class C deals, I mean, they're already, in some cases, $700, $800, $900 less per month than what you're gonna see in an A deal. So I think what you'd see is A deals would drop their rents at least a little bit. B deals would start capturing some of the people that would potentially, maybe some people that were going to go live in an A deal would now live in a B deal. And so maybe that they would benefit the most. And then, again, the C deals, people could say, hey, if I want to save dollars and I was just, was going to live in a B deal before, now maybe I'll live in a really nicely renovated C deal. B and C, the basis relative to the rents is so much more favorable than the basis relative to the rents of somebody who owned a Class A deal, if that makes sense. So I think B is would be ideal. I think C is next, and I think A, you don't want to be left holding the bag if the market really turned a lot.
All right, great. So we're gonna try this breakout room thing. I don't know how many of you guys have your camera on. If you don't have your camera on, try to turn it on. And we're going to put 2 of the guys in a room and then add some people and see how it goes. So I'm going to leave the main speaker's mics on. And maybe if you guys can do a little bit more of an intro to yourself, a little bit of background on yourself, and then we'll kick it around the room and take any questions from that group personally. So give me 1 second to put you guys in different rooms. Hold on 1 second.